Hey guys, what's going on? Welcome back to the channel. My name is Leo, and in this video here, we're going to be doing a stock analysis on Costco. And if you're new to the channel, welcome. We usually just do a deep dive into these companies from a value investing perspective. So welcome aboard. Without further ado, let's roll the intro and jump into it. Here's Costco. All right. So I added some new things here. Costco jumping in our stock research tool here. What we like to do first is go through the company metrics and just do a quick little comparison and kind of see where the company's been over the last 5 years and see where it's currently standing to see if there's any improvements, maybe things, some discrepancies, followed by a financial evaluation where we score the company and go through this lovely category right here, these lovely categories right here. And then finally, we do a price analysis to determine a fair price to pay. So here's Costco loaded up. Now I have put in some new hotkeys here, so look at that, guys. Now you should see the company metrics way better, full screen here. So now we can actually see what's going on. With our PE, we have a slight increase over the last 5 years. EPS is also growing. Not too thrilled about the PE increasing, but EPS being higher than our 5-year average, now that's something to get excited about. Also have an increase in return on equity compared to our 5 years. A slight increase on profit margin over the last 5 years. Revenue being $203 billion, and net income being $5 billion, with our free cash flow being $2.6 billion, and our average cash flow being $4.4 billion. Now, folks, a little bit of a problem here. We have a decrease in free cash flow, as well as we pay out 5.7, is that right? $5.7 billion in dividends? Like, let me see about that. Sorry, let me just check the cash flow real quick. Yeah, that's insane. Wow. Yeah, so we pay out a lot of dividends. And folks, if our dividends is 5.7 billion paid compared to our free cash flow being 4.4, that's not healthy. That means this dividend is nuts. They must be taking on debt, and I'll show you this in a little bit. But yeah, they must be taking on debt to pay out this dividend. That is not good. And the yield is only 0.59%. The juice is not worth the squeeze. So just be wary about that, folks. They're paying out a dividend they really can't afford. So that is quite concerning. Return on invested capital is 22%. Compared to our 20% 5-year average. These are phenomenal numbers, and I'll explain that in a moment once we jump over to the financial evaluations. Allman Z-score is 6.92, and Piotrowski score is 7. 7 is a decent number. We want this between 7 and 9, 9 being our highest score. And Allman Z-score is 6.92. We want that to be over 3. And with a company like this is where an Allman Z-score would apply because they have a lot of tangible assets. They are a major department store for wholesale, and we want this number over 3. Being at 6.92 indicates that this company is never going to be, it's highly not going to be at risk of going bankrupt. So yeah, overall thoughts on company metrics so far, pretty solid up until this point, but like I said, this free cash flow number is a little bit of it's a big discrepancy with this dividend being paid out, because that means they could be taking on more debt. So with the company metrics out of the way, let's jump into a financial evaluations and see where Costco scores. So pulling this up here, we're scoring this company at a 6. So where Costco is going to be losing points is going to be in the PE average, PE 5-year average, our current ratio, as well as our debt to equity and share dilution. Going through the discrepancies real quick, at 34.54 average PE ratio, we want this to be under 22.5. We don't have that. And with it increasing over the trailing 12 months, as we just saw in our company metrics category, I don't know what to say. I mean, they are bringing in more revenue, right? And the price is definitely being reflective of that, as you see this huge increase here over the last, well, it's been rallying pretty hard since 2020. It's probably one of the only businesses that wasn't majorly affected during the pandemic. So I don't see that dropping anytime soon. Now, granted, our current ratio is at 1.0. We want this to be between, or we want this over 1.5 rather, because we want to make sure that Costco has enough assets on hand to cover their liabilities. A 1-to-1 ratio is technically fine. However, we want that extra buffer zone, because with a 1-to-1 ratio, you're essentially just draining the tank, and there's no buffer zone. That's as simple as that. Now, with our debt to equity, we are almost at that 50% mark. We want this to be under 50%. We are at 53% here, folks. They're just leveraging their capital more so through debt and not through equity. It's still going to be a zero. Like, I got to be strict here, right? Because I want this to be under 50%. It's not, so it is what it is. Now, finally, share dilution. Our last discrepancy, 0.18% increase in shares over the last 5 years. It's not the worst thing. It's really not. But we want this number to be decreasing or staying the same. So with a slight dilution in shares from Costco, it's going to get 0 points from me. Now, on the positive side, the ROE is huge, 24%, 24.75%. We want that to be over 15%. It's got it. EPS growth of over 1,000% over the last 5 years, which is phenomenal. Like, look at these 2020 numbers, right? Like, where is it? Yeah, like March 9th, $300, and it just didn't stop. It had a little bit of a dip. What 56 to 42, dude. Just non-stop. It was the major cornerstone, I think, of the pandemic, and everybody was shopping at Costco, just loading up on toilet paper, for one, and then meat and whatever. That's for where I'm from. Good old Canada. And 5-year net income growth, huge increase. Like, well, look, you got points across the board here, folks. You can see this. Net income growth, free cash flow growth, return on invested capital average being 20%. We want that to be 10 or higher. And then finally, revenue growth being a 10% increase. No stranger here, folks. Costco makes money. However, as I was saying with that balance sheet and this dividends being paid out, it's something to be concerned about with our free cash flow technically decreasing. Now, this is the 5-year average. So I want to just see something. So if we look here, guys, in 2017, we had around like $4 billion in free cash flow. We had a decrease in 2018, slight increase in 2019, huge numbers in 2020, and then so overall, yeah, it is a slight increase. The previous years were absolutely terrible, but yeah, 2016 seems to be the big year when Costco started bringing in huge numbers. Those dividends paid, like it was no problem. Yeah, it could have paid it no problem. The last in 2020, but 2021, just getting absolutely slapped around here. Not good. Something to be concerned about, guys. It's just something to keep. It's something to keep in mind. But overall, it's decent. But these numbers, those are my main concern. Like other than that, like the revenue numbers are phenomenal. Right? Like it's just steamrolling. It's a power stock, guys. With that being said, folks, let's jump into a price analysis. But before we do that, make sure you hit the like button if you haven't so already, and the subscribe button if you're enjoying the video so far. Helps me out a lot, helps out the YouTube algorithm, and as always, makes me feel warm and fuzzy inside. So we're going to go through a price analysis here. I'm going to put some assumptions in of where I think the company's going to go within the next 10 years, because I don't see Costco going away. So we'll do 3 assumptions here: conservative, moderate, and aggressive. Now, I like to stay conservative across the board. So the numbers are going to really play with here. I'm going to go 6, 7, and 8. We've hit 7 in our 10-year, so I believe we could definitely hit 6. And 8 is probably somewhere just around that 5-year and 10-year number. Profit margin, I gotta go with 2 and 3. Or even just 2.5. Be super conservative. Free cash flow margin, I'm gonna just do same. Price to free cash flow. This is where it gets ugly, folks. Sitting at around 88. I'm gonna use my higher conservative metrics, or at least that's what I call it, like a 14, 16, 18. And PE ratio, I'll go 12, 14, 18. I'll do 12, 14, 16. Because realistically, like, we're bringing in some big bucks, right? 6, 7, 8% revenue growth 10 years from now. We should be paying a lower multiple for this. Desired return, lucky number 13. And it's not looking too good, folks. Not looking too good. 288 on the high side, 192 on the moderate, 78 on the conservative side. Now, some may say I'm being way too conservative, but I need to include that huge margin of safety there, folks. Just because, listen, I want to be wrong, but I want to be on the good side of wrong. And I mentioned this in previous videos where, let's say the company does grow. Let's say it is this number here, and they actually report they're growing 10% a year, right? Then at 10% a year, well, it increases it by 349. But for me, I want my lowest numbers to be where I think it has to be. Where the company has to go in like the worst case scenarios. Obviously, I want the company to do better, but you have to make that margin of safety as large as possible. I mean, within reason, so you can give yourself that buffer in case you are wrong and you're on the bad side of wrong. So that way you're not losing too much. That being said, our average price to pay for Costco is $186.72 with everything considered here. Now, if you're believing these moderate and aggressive numbers, essentially the company needs to fall in half from this $533 price. But that's what essentially needs to happen, and it kind of makes sense. It's sitting at a 45 PE ratio. And now, out of curiosity, if I just hover around the idea, let's say if I just do 20 and then 22.5. So in that halfway mark, roughly around the halfway point. So guys, ultimately, those are my thoughts on Costco. I definitely think it's in a power stock kind of realm right now. It's with the heavy rally from the pandemic and just kind of pushing through now into 2022. Like it hit a high of 563 at some point, right? Or sorry, 571 in the 52-week range. It went from 307 to 571. That's huge. Those are huge numbers. It's definitely a business that's going to be around for a long time. I think it's a solid one. My main concerns is this decreasing free cash flow, and it bounces all over. That's my main concern, along with these dividends that are being paid out. If this can fall sub 200, I would put this on a watch list to buy, because I think it's a solid business. The price isn't right, as well as this free cash flow discrepancy. But yeah, those are my thoughts. Let me know what you think. Drop a comment down below. Hit the like button. Hit the subscribe button if you haven't done so already. Guys, thank you so much for watching. I'll see you in the next video. Take it easy.